Trade tensions between China and the European Union have intensified recently, with both sides seemingly on the verge of a major rift. On July 5, China's Ministry of Finance imposed new sanctions on the EU, prohibiting EU-origin medical equipment from bidding on Chinese government projects exceeding 45 million yuan. The stated rationale was reciprocal retaliation, following the EU's decision last month to bar Chinese companies from participating in medical project procurements worth over 5 million euros. However, a question arises: the EU enacted its ban in June, so why did China wait until July to respond? It's likely that China attempted to negotiate with the EU in the interim, but those discussions failed. Observing Foreign Minister Wang Yi's recent conduct in the EU provides clues as to why these talks collapsed. Wang Yi adopted a strikingly condescending tone toward Europe, boldly declaring that China cannot accept Russia's defeat in the Russia-Ukraine conflict, as it would allow the United States to focus its efforts on countering China. This is remarkable, given that Russia has been Europe's primary security threat for decades. To openly support Europe's greatest adversary on their soil is nothing short of provocative. China has historically portrayed itself as a neutral mediator, but Wang Yi abandoned this pretense, adopting an overtly aggressive stance. This approach reflects not just Wang Yi's perspective but the attitude of President Xi Jinping himself. Xi has long viewed Europe with disdain, acknowledging only the United States as a superior power while considering Europe a lesser entity. Consequently, both China's official rhetoric and public sentiment toward the EU often carry an air of superiority and pressure. Yet despite its relative decline, Europe remains a global power and is not easily intimidated. Thus, the current breakdown in China-EU relations is hardly surprising. One can imagine former President Trump chuckling at this development, as China's actions inadvertently aid the US in repairing its ties with the EU. With an ally like China, it would be surprising if the EU did not gravitate back toward the American sphere. Xi Jinping's governance, however, is not limited to foreign policy missteps. His domestic policies are equally problematic. Recently, China has been promoting an anti-involution campaign. On July 5, tech giants Alibaba and Meituan launched massive food delivery discount campaigns, offering billions in vouchers with such generous terms that consumers effectively enjoyed free purchases. Meituan's app crashed under the surge of orders, which reached unprecedented levels. Who wouldn't seize the chance for free takeout? Yet this initiative appears orchestrated, likely at Beijing's behest, to distribute consumer vouchers and inflate spending figures. Tellingly, the stock prices of these companies plummeted shortly after, suggesting that neither the market nor shareholders approve of such profit-sacrificing measures. In this video, we'll explore two key issues: the China-EU fallout and the domestic food delivery subsidy war. Let's begin with the China-EU tensions. This year marks the 50th anniversary of diplomatic relations between China and the EU, presenting a prime opportunity to mend ties. Yet, Xi Jinping's approach has been remarkably short-sighted. He scheduled a China-EU summit in Beijing on July 24, adopting the posture of a superior summoning EU leaders for an audience. Given that China urgently needs to court the EU amid the US-led global containment efforts, one would expect a more conciliatory approach. Aligning with the EU could significantly bolster China's position in the ongoing trade war. Instead, Xi has offered the EU little of substance, resorting to superficial gestures. For instance, he lifted the 2021 sanctions on 5 European Parliament members who had highlighted the Uyghur situation in Xinjiang. Those sanctions merely barred entry to China, a restriction of questionable impact, as it's unclear whether these lawmakers were eager to visit. Such measures amount to little more than self-aggrandizing theater, lacking real consequence for the EU. Similarly, China's Ministry of Commerce recently imposed anti-dumping tariffs on European brandy while offering selective exemptions. This brandy dispute is almost comical. In January 2024, retaliating against the EU's anti-dumping tariffs on Chinese electric vehicles, China targeted EU brandy. After a 9-month investigation, China confirmed in October last year that European brandy was being dumped, imposing temporary measures requiring importers to pay up to 39% in security deposits based on wholesale prices. This caused the stock of Remy Cointreau, a prominent European liquor brand, to plummet by 35%. On July 4th, China concluded its brandy investigation and began levying formal anti-dumping tariffs, though it granted exemptions to 34 EU brandy exporters who adhered to China's pricing commitments. French officials noted that China has used the Brandy issue to pressure Europe into easing electric vehicle tariffs, a demand France rejected. This is understandable. Chinese electric vehicles are indeed being dumped in Europe, whereas European brandy is likely being unfairly targeted. European liquor industry associations have made their stance clear, accepting the pricing exemptions but firmly rejecting accusations of dumping in China, viewing them as baseless. Moreover, China has acted duplicitously. Last year it banned European brandy from duty-free shops, and despite promising the EU this year to restore access, it has yet to follow through. Duty-free sales account for 20% of French brandy's revenue in China, resulting in significant ongoing losses. China's baseless targeting of brandy reveals the coercive nature of its diplomacy. The EU has been relatively accommodating, allowing Chinese electric vehicles into its market, unlike the US, which has largely closed its doors to China. Last year the EU even proposed replacing anti-dumping tariffs with minimum price agreements as a compromise, but negotiations stalled and China resorted to threats over brandy. This pattern underscores China's lack of regard for the EU. Despite needing Europe's support, China employs strong-arm tactics and refuses to make concessions. The EU, however, has itself to blame for its heavy reliance on the Chinese market, leaving its supply chains and exports vulnerable to China's whims. Now, China's true intentions are clear, as it exerts pressure without restraint. China's latest sanctions, restricting EU medical equipment from government procurement, are framed as retaliation for the EU's earlier ban. In reality, they reflect Xi's frustration after failed diplomatic efforts. The EU's restrictions were announced last month, but China's response came only on July 5, suggesting negotiations occurred in the interim. China has been using Europe as a dumping ground for goods blocked by US sanctions and is now eyeing the EU's expanding defense budget, hoping Chinese firms can secure contracts, even for dual-use components. During his EU visit, Wang Yi emphasized expanding bilateral procurement and opposing the securitization of trade, signaling China's desire for defense-related deals. However, even the most pro-China EU leaders cannot acquiesce. With Russia as Europe's primary security threat, Wang Yi's declaration that China cannot accept Russia's defeat stunned EU officials. It's tantamount to admitting alignment with Europe's adversary while seeking defense contracts, a diplomatic blunder of astonishing naivety. Xi's approach, whether born of overconfidence or arrogance, dismisses the EU entirely. Yet he expects Europe to align with China and distance itself from the US, a profoundly misguided expectation. Domestically, Xi's policies are equally short-sighted. On July 5, a massive food delivery subsidy war erupted, with Alibaba and Meituan distributing substantial vouchers, discounts like 21 yuan off 25 yuan orders, or 15 yuan off 15 yuan, effectively enabling free purchases. Social media buzzed with screenshots of 0 yuan meals, and the overwhelming demand crashed Meituan's servers, which hit record order volumes. Meituan attributed the crash to rate-limiting measures triggered by the surge. This may appear as a market share battle between Alibaba and Meituan, reminiscent of past platform wars. However, it likely reflects a coordinated effort, directed by Beijing, to distribute consumer vouchers and stimulate spending while aligning with Xi's anti-involution campaign. Taobao announced 500 billion yuan in subsidies starting July 2, with orders spiking by July 5 due to weekend demand. Notably, subsidies extended beyond consumers to merchants and delivery riders, doubling riders' hourly pay and delivery fees. Unlike past promotions, where merchants bore much of the cost, the tech giants are now shouldering the bulk, alleviating pressure on businesses. This creates an impression of conscientious competition aligning with Xi's call for common prosperity. In the short term, this benefits consumers, who have enjoyed near-free takeout. However, shareholders of Alibaba and Meituan are likely less enthused as subsidies erode profits. Without a corresponding increase in market share, these expenditures risk becoming losses. Stock price movements reflect this. Rising stocks would indicate investor optimism, while falling stocks signal skepticism. Unfortunately, both companies' shares declined, suggesting that this subsidy war is driven more by political directives than business strategy. Otherwise, why would profit-driven firms subsidize merchants and riders so generously? It's as if Alibaba and Meituan are assuming a state-like role, distributing vouchers on Xi's behalf with a heightened sense of social responsibility. Many may view these tech giants as exploitative, using algorithms to squeeze merchants and riders, This perspective is understandable, but we must consider the broader picture. Forcing companies to fund public subsidies is unsustainable, as their profits support shareholders and employees. Bankrupting a ruthless corporation could lead to thousands of job losses. While Meituan may face criticism, it provides delivery jobs. Corporate behavior requires legal regulation, and in the absence of robust laws, unscrupulous practices persist. The root issue must be addressed. In summary, Xi Jinping's domestic and foreign policies are deeply flawed. Diplomatically, he exhibits a bullying demeanor, now so emboldened that he disregards the EU, using coercive tactics to force compliance. This has only clarified China's intentions, enabling the US to rally allies more effectively. Nations now recognize that dependence on China's market or supply chains risks humiliation and loss of sovereignty, yet Xi seems oblivious to the possibility that Europe might resist, inadvertently pushing it toward the US. His confidence in dominating Europe is both perplexing and dismissive. Domestically, the anti-involution campaign dominates, but with special treasury bonds exhausted, Xi has shifted the burden to companies. Alibaba and Meituan have complied, distributing subsidies to boost consumption, but at a steep cost. It remains uncertain how long they can sustain this before their stocks suffer further. Investors should exercise caution with Chinese stocks. Today, it's Alibaba and Meituan. Tomorrow, it could be Tencent or JD.com. Every major tech firm will likely be enlisted to support Xi's consumption stimulus, as China's fiscal resources dwindle. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.